Hey guys, so today what I want to do is I want to build a value screener, and the idea behind this is I want to relatively value the investing universe of securities based on different relative value metrics. That is your PE values, price to book, price to free cash flow, price to sales, and I want to be able to build this screener so that we can find relatively undervalued companies versus the investing universe. So to do that, we need to be pulling our data from a company called Finviz, and Finviz allows us to use their screener and we can export this into a CSV file. So I've already done that. You can create an account there and you can do that. I've already created a CSV file. This is data from 419, and what we're going to need is we're going to need a few libraries: pandas, numpy, matplotlib. Here I'm using a set option. That's just a option that allows us to view 500 rows of data in this IPython notebook. So we can run that. So what I'm doing is I'm using pandas read CSV function here, and I'm turning it into a pandas data frame, and I'm calling that df. So there we go. So we can view what the data is in here. You notice that we have lots of different data sets, data variables. We're going to be looking at these PE multiples and price to sales, price to book multiples. So the idea behind this is that what are these multiples? So you can look at relative value metrics as a way to compare similar companies. So for example, if you had two companies in the same industry, same business characteristics, same business model, a company with, for example, PE values, you'll find that a company that has a PE value of 20 versus a PE value of 10. So what is a PE value, first of all? So that is just your stock price divided by the earnings per share of that company. And given the similar characteristics of these two companies, the idea is that a company that gives you a higher bang for your buck, per se, versus a lower company. So for example, if you had a price multiple of 20, so that's the stock price divided by its earnings per share of 20 versus a PE value of 10, the company that had a PE value of 10 would be considered undervalued because you're getting a better quote unquote bang for your buck for that company, right? And so you would rather invest in that one versus the company that had a PE value of 20, that would be considered overvalued versus that other company. So we can apply that same methodology to the universe of companies to determine which companies are undervalued versus overvalued in terms of the entire universe of companies in the market. So what we can do is, let's take a look at this data. So you notice there's about 7,600 companies in here that we're using. We can look at the sectors. And so there's healthcare, basic materials. What I want to do is I want to remove this conglomerates sector because it's not exactly useful, and I want to look at specific securities. I want to remove any funds. So we're going to remove ETFs, closed-end funds, debt and equity. So that's what I'm doing here. It's not equal sign. So let's take a look at our first price multiple, PE. So let's take a look at what it looks like in the data set. So you'll notice there's this really large skew. There's a very large multiple here. Let's try to reduce this so we can see exactly what this distribution looks like. So you notice it's very much skewed. And the reason for that is there's a multitude of reasons for that. So this data set may have missing data. It may have earnings, specifically it may have earnings data that is negative so that the PE ratio will be non-existent. It would be not important. So what the idea behind that is that when you're comparing two PE ratios, if you have a negative earnings yield, it doesn't make economic sense to be comparing a PE ratio that has a negative earnings versus a PE ratio that has positive. You can't really compare those two. You can't really determine which one is undervalued or overvalued. Even if you had two negative earnings companies and you had a PE ratio, that doesn't make intuitive sense of, okay, are you paying more for negative earnings versus paying less for another company with negative earnings? That doesn't make intuitive sense. So what we can do is we can reverse this PE ratio and turn it into something called the earnings yield. So the idea behind that is you just take the earnings and you put that in the numerator divided by the stock price. And if we do that, then we can actually compare companies versus other companies, even if they do have negative earnings. So for example, you can have two negative earnings companies, but it's the one company may have a very small negative earnings yield. So maybe a negative earnings yield of negative 0.75 versus a company with a negative earnings yield of negative 0.5. So the company with a earnings yield of negative 0.5 would be considered undervalued versus the company that's really giving that really large negative earnings. So let's view that visually. So what I can do is, if you look at this data set, there is a variable here called earnings per share, TTM, for trailing 12 months. And you also notice that there's a variable here called price. And so what I'm going to do here, so if we look at the original data set here, is we can find that EPS trailing 12 months. I'm just going to take that and I'm going to divide it by the price. And I'm going to create a new column called HEP. And that's just going to stand for historical earnings to price, or historical earnings yield. And the reason why is because later on I'm going to actually look at forward earnings yield. So just to segment the two. So let's run that, create that new column, and we can take a look at this data. Again, hard to see because you'll notice that we must have very large earnings to yields here, earnings to price ratios here, and very large or very small negative earnings to price ratios here. So let's try to close this data up and take a look at it closer. So there we go. So you'll notice that we have a much better normal distribution here. And so the great thing about this is we can actually begin to make some statistical inferences here. And when you make the assumptions of a normal distribution. So the idea behind that is we can determine, okay, what's the probability of a company having an earnings yield greater than 1? What's the probability of companies having an earnings yield between 1 and 1.2? And same in reverse. What's the probability of a company having a earnings yield less than negative 0.75, or between negative 0.5 and 0.75? We can produce or have statistical inferences of these distributions and understand what's the probability of these different earnings yields. So that's a great thing about having a normal distribution here. So that's much easier to work with than this distribution here, this multiple, where it wasn't normally distributed. Okay, so we can do that, and then what we're going to do is we're going to convert this later into something called a z-value, which is going to help us make those statistical inferences. But we're going to find that some of these other multiples don't have normal distributions, so we can't produce any statistical inferences of them. And but that's okay, because the end goal of this is to screen these and rank these companies. So we're not going to actually do any statistical inferences in this video. Maybe in another video I will. But we'll just go through the process, and then at the end we're going to rank these companies so we can create a ranker. So let's do that. So now what we're going to do is let's take a look at price to book. And so what's the economic intuition behind price to book? Again, that's just you're taking your book value of a company, and that is just your total assets minus your total liabilities. That's something called book value or shareholders' equity. And you're going to take that book value divided by the shares of the company, outstanding shares, and that will give you your book value per share. And so what we're doing is we're taking the stock price divided by the book value per share. And the intuition behind that is that a company with a low price to book versus a company with a high price to book, if they're relatively in the same industry, same business model, etc., the company with a lower price to book, you're getting essentially a better bang for your buck again. And so that would be considered undervalued versus the higher price to book would be overvalued. Again, that's a very small sample size. We want to look at a larger sample set, so that's what we're doing here. So we can take a look again at another price multiple, price to free cash flow. And that's, again, we have this skew here, and the reason is because we don't have, in this case, we don't have any negative operating free cash flow, at least in this data set. We want to also look at forward PE. So let me tell you the intuition behind forward PE. So forward PE is just your stock price divided by the forward earnings per share. And what is forward earnings per share? That's usually determined by guidance from the company and analysts' forecasts of earnings for next year. And this is a great multiple, and usually I like forward PE much better than historical earnings PE. And the reason why is because finance is a forward-looking exercise. You're looking into the future about what earnings will be, and you make investments in companies or lower allocations to companies depending on the future value of those earnings that you're going to get, right? And so that's why forward PE is usually a better determination when you're relatively valuing companies. If you're going to look at two companies and one's going to give you less earnings in the future versus the other company giving higher earnings in the future, you would value the company with a greater earnings potential in the future. When we're looking at that, that's the economic intuition that we're looking into. So again, it's the same economic intuition. A lower forward PE versus a high forward PE. The lower one would be considered undervalued, the higher one overvalued, given the same business model, same business characteristic, similar sectors, industries, so, and geographic locations as well. So we can look at this. You notice that we have this skew. Again, that's because in this data set, we're not having a full view of guidance into the future of companies that have negative earnings, and this data may be missing. So the problem is, again, it's harder to make inferences about this data. That's okay. Let's take a look at, because we're just ranking here. So let's take a look at dividend yield. Again, have the skew. It's because, a company can't really give out negative dividends, so you wouldn't have normal distribution here. I've actually segmented the data into sectors, but we're not going to actually use this in this workbook, but for future reference, you can use that. And now what I'm going to do is I'm going to create something called z-value. And so the z-value is going to help us do our statistical inferences. And remember, it's only useful when you have you're assuming a normal distribution, essentially. And then we can make those statistical inferences of what's the probability of an earnings yield greater or less than a specific value that we hypothesize. So we can produce these z-values. And so what a z-value is, how to calculate that, you just take the specific observation. In this case, I'm looking at the historical earnings yield, and for the particular company, subtract that from the mean or the average of all the securities and its historical earnings yield. So what's the average of all these companies' historical earnings yield? And I divide that value divided by the standard deviation of this population of historical earnings yields. And remember, that was that 7,600 number. So we're going to run that, and you can see we can look at the distribution. Again, when we're creating a z-value, we're standardizing the data. And so you notice this is basically saying this is negative 30 standard deviations. This is a positive 30 standard deviations, assuming the normal distribution, right? So the idea behind normal distribution or z-distribution is that about 68% of the observations are found within one plus or minus one standard deviation from the mean of that population. And about 95% of the observations are within 2 standard deviations above and below the mean of that population. So that's the idea, the intuition behind using these normal distributions. So then we can make the determination that 95% of these companies will have a historical earnings yield between 2 standard deviations, plus or minus 2 standard deviations of the mean of the historical earnings yields of this the population. So that's the whole intuition of why we're using z-values. Again, we're just going to be ranking these companies because we'll notice that some of these other multiples don't have normal distribution, so we can't make any statistical inferences of them. But at the end of this goal is just to make a ranking, so that's okay. So again, we can take a look. You can see about 1 standard deviation. We can notice these are the observations within 1 standard deviation of each other. So that's about 68% of the observations or of these companies are within here, this earnings yield, historical earnings yield. So let's move forward. So I'm going to take a look at forward earnings, price to earnings. And what I'm doing here is, and I'm taking 1 divided by the forward PE ratio. And the reason why is I just want to inverse it. And so that's just a mathematical way to inverse it to create a earnings yield, a forward earnings yield. So I'm just taking the PE value and I'm reversing it, putting the earnings to the numerator and stock price in the denominator. So I've done that, created a new column called FEP for forward earnings price or forward earnings yield. This is just a replace thing. What I'm doing is what happens is some of these companies have 0 and you can't divide by 0, so you get an infinite number. So I'm just replacing that and putting that to not a number in NumPy, np.nan. So that's all I'm doing there. And because when I do that, now I can actually create a z-value here, which is not exactly intuitive in this case, but I'm just doing that just for future reference. Might be easier, so we can take a look at what that looks like. Forward earnings yield. And just to describe, you see again, we still have that skew here. So it's not intuitive to make any statistical inferences given that skew. It's not exactly normally distributed. And it's a little harder to make those statistical inferences. So I'm just going to run through this. And so I'm doing the same thing with price to book. I'm reversing it. So I get instead of price to book, I'm getting book to price or book value to price. It's like another yield in a sense. I'm doing the same thing for price to sales. Cash flow, I'm just reversing it. I'm putting free cash flow to the numerator and stock price to the denominator, creating a z-value. Now I have all these different z-values. And I'm doing the same thing for dividend. So I'm taking dividend, and again, for dividend, I didn't have to reverse it. I didn't have to take 1 divided by the dividend because it's already in the form that I want. And so essentially, I want the yields, and I want the book values, I want the sales all to be in the numerator divided by the price. And so the idea is the higher those numerators are, the higher those ratios, that would be a more undervalued companies, versus the lower those ratios, that would be a very overvalued company. And so what we're going to find is, because I'm converting all these into z values, what I'm going to do is I'm going to find the mean of them. And so I'm going to take the z value of the historical earnings to price, the z value of the forward earnings price, book price, z value for sales to price, z value for cash flow to price, and z value for dividend to price. And so, and what you find is a value of, and let's just take a look at forward earnings yield, for example. What we're doing, a value of 1, a very high value here, is going to be considered a very undervalued company. A very low or negative value is going to be an overvalued company. So we'll see these z values. If you looked at them, very high positive numbers, undervalued. Very low negative values, overvalued. And we can rank. That's what we're going to rank. But what I'm doing here now is I'm just going to take the average of these. And you can do this in other ways. You may want to maybe give a greater weighting to the forward earnings yield, which is personally what I would usually do, and maybe book to price, and a less weighting to historical. But in this video, I'm just going to assume that all of these have equal weighting. So I'm just going to divide it by 6 here, I believe, and then I'm going to create something called a z-value here, z-scores. So we've done that, and now we can take a look. We can sort these values. So that's what I've done here. And so you can see we have all these z values. We converted all these different, so for example, price to book to z value. But then I've averaged all of them to get a full z value. And so now we can rank all of them from highest to lowest. You know, Berkshire Hathaway is up there, but that may be an outlier actually because of the data set. And we can also take a look at what's missing here. This is about some null values here, but that's okay, out of our 7,000. Let's take a look at the distribution of this. And so you'll notice here, again, why are we having this big gap here? And it's because we're missing some data. See, if we just used our original earnings yield, which was a much cleaner data set, you know, we had negative earnings numbers. Problem is we added all these other variables that don't have negative values or had missing data. So we're getting this issue here, but that's okay because we're just going to rank it. Just going to rank these companies from positive and negative z values. And so that's what we're going to do here. So we'll take a look at, so what I'm doing here is I'm just taking a look at the companies that are greater than 1 standard deviation. So let's just rank these companies. So we can rank the percent rank. So what I'm doing is I'm taking this our z value, and I'm using a function called dot ranked, and then I'm making sure it's a percentage, and I'm creating a new column called percent rank. So you can take a look at what I've done here. So if we take a look at our data set now, we have our z value, but now we have a percent rank. And so what that's saying is that a company that has a very large z value, that would be considered, for example, look at the companies that in the 90th percentile of companies that have very large z values. So that would be considered very undervalued, right? And so we can run that, and we can look at companies that are greater than the 80th percentile. So we can look at that. So we'll notice about, and I'm counting them right here. I use a function .count. So there's about 979 companies that have a z value greater than the 80th percentile. And so what we're doing here. So this is what we care about. This is our final line here. And so what I'm looking at is I'm going to take each company, its percent rank. I'm going to make sure it's in the 90th percentile, and then I'm going to sort values by the percent rank so we can see that. So let's run that. So I'm going to sort it from largest to smallest. So there we go. So we can notice that we can see these companies here, and we move all the way to the right here. This is number 1, William Petroleum Corporation, Berkshire Hathaway, Noble Corporation, all that very high percent rank. The percent ranks greater in the 90th percentile. And so you notice they have the largest z value. So if we moved all the way down to the bottom here, almost to the bottom here, you'll notice that some of these companies have a much lower z value of 0.32, 0.31, 0.30, 0.3. But let's look at companies that were in the bottom 10%. So less than, let's say, 0.10. And we'll send it. And so these are companies that have a percent rank of less than 10%, and we can see that they have negative z values, right? So they're on the lower end of this distribution over here. If we look at our distribution here, right? And so that's the whole idea that we're doing here. It's ranking companies. So we've accomplished that goal. This last little thing is that I'm just looking at the sector means of the historical earnings price. I just wanted to see that, just see by sector which companies have higher earnings yield versus others on average. We can group by industry as well. And that was just the idea here. So that was the goal of this exercise. But just to begin, notice how if I put this back to positive 0.9, and we look at the 90th percentile, notice how, yeah, that's great. Some of these look relatively undervalued, right? But remember, this price multiples are a backward-looking exercise. Many of these are, at least for historical earnings yields. We need to look forward, and you'll notice what we need to do is maybe what we should do is some of these companies we should apply a quality screen on top of these, because some of these clearly aren't. Yeah, they may be oversold and giving you a very high dividend yield, a very high earnings yield, etc. But are their balance sheets strong? Do they have future growth potential? Are they able to service their short-term obligations, etc.? So a better screen would be to apply this value screen, and then on top of that, a quality screen, and rank these companies so that we can clean this up. Because, for example, we know that if you were watching the news, we know that Whiting Petroleum Corporation, I believe, is going to go bankrupt. So it's very high on our value screen here. But is this really a strong balance sheet company and also industry? Those are the questions that we have to produce. Just because you have a screen that's giving you relatively undervalued companies, that doesn't entirely mean that they're undervalued. Where finance is a forward-looking exercise. This is just a screen to give us an idea of like what are the odds of these companies doing well in the future. And statistically, undervalued companies or low PE ratio companies do better in the future, at least on the historical academic data set has shown. But I think a better approach is to look at these companies and use this as an idea of, okay, these are companies that are interesting. We should produce some time here because maybe other analysts are not covering these specific companies because they get sold off so much. But there might be some value here, but your job as an analyst is to determine where is that value, where is the future growth of these companies, and basically separate the winners from the losers. So if you like this video, guys, please subscribe. In our next video, I'll probably produce some type of quality screen and maybe even go into specific companies and value them on an individual basis. So thanks, guys.